Perfect. Thank you. Right, now, before I start, I thought I'd share a thought for the session. The budget is not just a collection of numbers, but an expression of our values and aspirations. So to me, when you have a budget, it is you do your business plan and you work out your vision and your goals for the year, and then the budget is the money side of things that you put to that plan or to those goals, so that you can figure out what the effect of that plan is going to be if you follow it. So when I say hopefully you've all updated your budgets and forecasts for this new financial year, I know that most people haven't, and so it's almost like a crusade for us to get people thinking in that way. So the numbers express your aspirations for the business over the next 12 months. And so now it's time to make sure you can understand and monitor and measure what you've set in those budgets or forecasts, or what you will do when you do start budgeting and forecasting. So this webinar is about demystifying the most common reports you'll be seeing on a monthly, quarterly or annual basis, so that you're in control of your business performance. Okay, so over the next 30 to 45 minutes, I have ditched some slides today because they just got a little bit OTT for even me. So we're going to cover the importance of knowing your numbers, an overview of the different reports you should be producing, the difference between profit and cash, the key drivers of business value, and how to adopt best practice. And we'll then outline some potential next steps for you and to make sure you truly understand your numbers. So please make sure you take plenty of notes. Some of what we talk about might sound like a foreign language. So if there's bits you don't understand, just pop it in the chat and let Nat know. And like I said, I am going to try and keep it real. There is jargon though, so I will try and explain that at the time. Just send your questions through to Nat and we will get to them at the end. This is really random because I can just see Nat and that's all. Beautiful. Okay, so knowing your numbers is vital as it allows you to interpret your reports and know if you're on track to achieve the goals set in your business plan. So here's my top 6 reasons why you need to know your numbers. So firstly, they tell the story of your business, and they are the result of the plans that you make, the goals that you set, and the actions that you take. So, you know, when we, well, you might not know, when we talk about taking responsibility and accountability for the things that you do in your life, same goes for business, and the numbers are, I guess, the proof of what you've done. And so it's the result. So number 2, they quite often show you the symptoms of problems that are within your business. So I have got some notes on that one. So for example, a decline in your gross profit, which is your sales less the cost that it takes to make those sales. A decline in your gross profit is a symptom of, it could be things like ineffective pricing or rework or poor purchasing or wastage. And so if I just put that into real terms for you, so the minimum wage has just gone up, and perhaps you haven't reflected that in your selling price if you've got staff, or you have an employee that keeps mucking up their bit on a production line and you're having to redo the work and fix mistakes, or there might be training required for a staff member because they're not quite meeting their output targets. So your financial statements will show that, and so being able to understand them means that you can drill down and identify what those problems are. So it is a early warning sign of a potential issue. For example, monitoring how long it takes customers to pay you allows you to quickly respond if that number starts to increase. And we will talk about that later in the session, just how you can use those. It's called debtor days. It's basically monitoring how long it takes everyone to pay you. And then you will see, like you might have seen during COVID, for instance, that those days got, it took longer for people to pay, basically. So just being on top of that and noticing that sooner rather than later means that you're going to get that money in the bank sooner. Areas of strength and weakness will be highlighted. For example, your balance sheet indicates whether your business value is going up or down. So for those of you that are thinking of selling your business at some point, there will be indicators in your balance sheet that basically tells you whether you're going into the right direction or not. Understanding your numbers also means you have reliable financial information to base your decisions on. And so this is where a really good bookkeeper can come in, because as long as your data is clean, you can rely on that information to make your decisions. And finally, knowledge is power. I used to say this a lot, knowledge is power, and then I realised, thanks to my coach, that knowledge is only power when you take action. So when you've got the right information, you can take the right action in your business. Right, so we will be reviewing each of these key reports to help you understand what you can learn from them. We're going to work through an example. There will be lots of numbers, and I know, because I know some of you, I know that you may glaze over a little bit. So just once again, maybe jump off the couch and do some star jumps or something to keep yourself awake, and put some questions through to Nat. So we're going to have an example. Now, if you're a sole trader, which means you're not operating in a company and you do your tax return in your own name, the last two reports you probably haven't seen before, so they won't apply to you. But good to know if you are thinking of growing your business at some point and you may move into a company structure. Okay, so we're going to start with the trading account. This is the little bit, if you've seen your financial statements from your accountant, this is the little bit at the top. And to me, this is the juicy bit. This is the bit where it shows the direct results of your actions that you take in the business. So it's got your sales, it's got the cost of making those sales. So if you buy and sell stuff, it's the purchases. And then it's also got the direct expenses that relate directly to making those sales. And I think when you're looking for improvement in your business, this is the area where you can make the most improvement. So we will be talking about gross profit, which I will show you in a minute. And that indicates whether your margins are improving or deteriorating. And you can, with this trading account, you can track your sales and your gross profit across, say, different locations. So if you've got a branch in Napier and one in Christchurch, you can use the trading account to monitor both of those and see how each individual branch is going. You can also do it for, say, different revenue lines. So, like in my business, we would have accounting and bookkeeping, and then we would have coaching. So I would be able to see how each of those revenue lines were performing in my business before we took off all the rest of the expenses that don't directly relate to them. And you will be able to see how small adjustments in the trading account can affect the bottom line, basically. I don't know if you can see me pointing either. Yeah, okay. Okay, so this is an example of a food manufacturing company, and you can see that they had, hopefully you can see that highlighted here, they had just over $1 million in sales, and they had a cost of sales of just over $300,000. So that cost of sales, like I said before, that is, in this example, that relates to your stock. So this company buys stuff and sells stuff. So you've got your opening stock that they had at the start of the year, the stuff that they've bought, and then they've done a stock take at the end of the year, and that comes to your cost of sales. And they have a gross surplus from trading of just under $700,000. Their direct costs, so these are the costs that you can specifically trace to making those sales, and they are costs that go up and down as your sales go up and down. Excuse me. So it wouldn't be like your rent, which stays the same regardless of how much you sell. So these are directly related to your sales. So your direct costs are just over $450K, and giving you a gross surplus of $248,749, and a gross profit of 24%. So lots of numbers in there, and each line is particularly important. So in this example, let's say that this company undertakes coaching with their accountant because they've seen the light, and they know that that is going to help them. And they implement some strategies to increase their customer retention rate, which means that they've put some marketing in place or done some training with their people, and they have managed to get their customers staying longer, buying more, or buying again, that type of thing. So it results in a 10% increase in sales. So that is, they also work with their accountant to review their inventory processes and reduce their cost of sales by 5%. So that's that little one there. And then they renegotiate their contract with their delivery provider, resulting in a 5% saving in direct costs. So these things, while you might not rush in a couple of months and do all of them, it could be that your target for the next quarter is to do maybe one of them, because I know from experience in business that it's quite overwhelming when you take on change of a whole lot of things at once. But even if you just did one of them, we're going to show you the results of what that looks like. Where am I up to? Maybe if I click, it'll tell me. Okay. So as a result of these changes, their gross surplus has increased by 140K. Where is that? That's over there. I think I've got a bit ahead of myself in the clickiness. Hang on. Oh, there it is. Cool. So they've made the changes and they've increased their gross surplus by $140,000. So those little tweaks, that 5% in your direct costs, that 5% in your cost of sales, and 10 in sales, it actually makes quite a big difference to the bottom line. So they've increased their gross profit percentage from 24% to 35% as well. So I guess the gist of it is understanding the trading account and how it works, and how small changes it's like they're magnified, and they can make quite big changes in your profitability and your bottom line. And just a quick note on that, if you are tracking your gross profit percentage, which is the 2 percentages at the bottom there, you can set this up in your Xero account to show you daily on your dashboard, so you can see in real time that you're heading in the right direction. Is there any questions there, Natalie, or is everyone still awake? Oh, 2 thumbs up. Awesome. Thank you. Right. So next we're going to talk about the profit and loss statement, also known as an income statement, or simply a P&L, which is what we use around here. And this shows all of your income and all of the costs over the year, and tracks the overall performance of your business. So this is probably the most used report in our business, because you can compare this month to last month to the month before, and all these reports are really easy to pull out in Xero. You can compare this year to last year. You can compare your business to, say, a similar business in another region. So we've got access here in New Zealand to benchmark statistics from the Department of Statistics. They are usually at least a year old, but they're really good if you want to check your performance against a similar size business in a similar region. So you'd use the P&L for that. Okay, I did go off script there. So it's important to remember when you're looking at the P&L that just because you might be showing, say, a $40,000 profit, and most of you probably know this, it's not the same as you can't then go to your bank account and expect to see $40,000 cash. So the profit shown in your profit and loss statement includes non-cash expenses like depreciation, which obviously reduces your profit. So you need to ensure you have sufficient profit to cover cash costs that aren't in the P&L. So things like loan payments, asset purchases, and drawings. So this is an area where I do know that a lot of clients really struggle with that whole thing between I've made a profit, but where's the money kind of thing. So we're going to look at that a little bit. I've talked about benchmarking, that's cool. And the other thing is that businesses are generally valued using a multiplier of earnings. So, which means that, say, for instance, in the accounting industry, our businesses are valued at like a 1 times or 1.2 times our earnings. So if I was to sell my business, theoretically, I would be advertising and marketing it for 1 times well, I'd be trying to get 1.2 times, to be honest, my earnings. And that sort of is an indicator of the value of your business. I guess it's a bit like when you want to sell your house and people look at the rateable value. So just a heads up then, of course, that if you are thinking of selling your business in the next sort of 3, 4, 5 years, your P&L needs to be squeaky clean. So here in New Zealand, Kiwi business owners like to get lots of bang for their buck and put a whole lot of sort of personal stuff through their P&L. And, you know, you can justify that and that's fine and it reduces your taxes. However, when you come to sell, it goes the other way. And all of a sudden you're trying to get rid of all these extra expenses. So this is where all that action happens. Realize I started waffling then, so going to move on. Nat's given me the look. Okay, so here is an example of a P&L statement, and for the same company we were working for before. And for those of you that have had annual accounts done, this is probably looks a little bit familiar to you. So we've taken the gross surplus from the trading account from before, and then listed all of the expenses. You're looking at this all the way down here, and then we've got the owner's remuneration, which is your shareholder salary, at the bottom. So as you can see, the company is currently trading at a loss of $113,000. Now that always freaks me out a little bit when you've got a company doing $1 million turnover and they still make a loss, because I don't know about you guys, but when you're just starting out, you're like, oh, if only I could get to $1 million, then I'm going to be, you know, take a decent wage and I'm going to be rolling in it. But that is not always how it works. So let's say the company undertakes a review of all their expenses with their accountant, of course, and identifies potential savings to be made to their insurance and rent. So they contact an insurance broker and their landlord and negotiate a 5% reduction for both expenses. So they've saved, that's that. So they've saved $597 on their insurance and just under $3,000 in rent. Wouldn't that be good? However, you'll notice that the accountancy fees have gone up. And if you remember in the previous example, the company engaged their accountant for coaching and other services. So a worthy investment, in my opinion, obviously. So despite the increase in their accountancy fees, the overall net surplus has increased by $138,000 to $24,000 net profit due to the savings that they've made. So that's a good result. So they've gone from minus $113,000. They've made those changes in their trading account with their sales and the cost of sales, and then they've also managed to cut back on some overhead expenses and basically turn that loss around to a profit. Right, moving on to the balance sheet, also known as the statement of financial position, and it provides a snapshot of your business's financial position at a specific point in time. This is not as glamorous as your P&L. It is a report that accountants get really excited about because it does measure your net worth of your business, meaning your assets less your liabilities, and the result of that gives you your net worth. So once again, if you're coming to sell your business, that's very important. It does show whether your business is solvent or not, meaning just that, your assets minus your liabilities. Do you actually own more than you owe? You can compare between periods, and it is useful for tracking the strength of your business, but also what accountants get really excited about is doing these ratios, which can show you how your business is growing or not growing and how it's tracking. So not a lot of clients focus on this because it doesn't really tell you how much tax you're going to pay, and that's what everyone wants to know. But there is some juicy stuff in there if you know where to look. So we are going to have a quick look at the balance sheet. There will be maybe a few things in there that you've never seen before. And that's okay, because if your business has a balance sheet like this, then perhaps we can get together and have a look at it together. But you might be a sole trader that has just maybe sort of half a dozen things in there, and it's a lot simpler. So try to stay with me now. Remember, star jumps, they are good. So this business is currently insolvent, as it has more liabilities than assets. Its working capital is also negative, as its current assets of 138k are less than their current liabilities of 162k. So basically, if someone came knocking on their door and they had to pay all of their current liabilities tomorrow, they would be short by, I think it's about $24,000. And that's what that working capital, that's what that little calculation means. So the company cannot pay its short-term debts from the limited cash, debtors and stock it has on hand. And basically the upshot of that is that the shareholders theoretically need to take action, or the owners need to take action and do something. So this is the point when my dad would have started selling cars and injecting some cash into the business. However, you could take out a loan equity on your house, you could get someone to invest in your business, or you could run around like a loony and have a sale, sell some inventory, collect some receivables, and basically do what a lot of business owners do, and that's just juggle that debt. So, if you're in that situation and you needed the suppliers to keep supplying you with inventory, you want to make sure that you pay them and keep them happy and keep those accounts as current as possible, because that's what's going to get your stock in and turning over and making profit to pay some of the other debt. I haven't been clicking, have I, Nat? Yes, so the $305,000 at the bottom is basically showing you that the company is insolvent and the directors do need to do something pretty quickly. In New Zealand, this is a company. So in New Zealand, the company legislation says that a company is not supposed to trade while insolvent, and so you will need to have a promise from the directors or the shareholders that you will support the business, and that is a legal thing, and it's only sort of really been talked about a lot since we had COVID and lockdown and that sort of thing. So just going through the notes. Okay, I'm just going to, yes, okay, debtor days. Okay, going backwards in my notes. I did mention debtor days before, so these are strategies to improve the cash in your business. So to calculate your debtor days, you divide the debtors, which is your accounts receivable, by your sales, and then multiply by 365. I never manually do that calculation because Xero can actually work it out for us. And it's in the Xero Business Snapshot report. So if you go in there, it will tell you your debtor days number. But basically what this means is that currently their debtor days are 26, and that means that on average, it takes customers 26 days to pay their bills. And then, so if you, I must remember to click, if they updated their terms of trade and requested payment within 7 days, and then managed to reduce this by 5 days to 21 days, they would have an additional $13,944 available. So it's accounting magic that makes money come into your bank by basically chasing up money that's owed to you, chasing up your debtors. Having better terms of trade can create more funds into your bank that you can spend on inventory, that you can turn over, make more profit, and improve the situation of your bank balance and your balance sheet. Inventory days is very similar. There is a manual calculation there, and it tells you how long the business holds its inventory before it sells it. So basically how long your cash is tied up in inventory. So for this company, it's 74 days. And if they reviewed and updated their inventory processes and reduced the amount of inventory they have on hand, they might be able to improve the inventory days by 9 days. And that would result in a cash flow boost of $7,860. So if you can imagine with that one that you've got something sitting on your shelf and the profit on that item is $10. If you sell it twice in a year, you're going to make $20. If you sell it 5 times in a year, you're going to make it $50. So the faster you can turn that stock over, the more profitable your business will become. So this together, improving your debtors and your inventory in this example gives a cash flow gain of nearly $22,000. It doesn't fix the solvency issue. However, it does demonstrate how much cash could be saved with some help in this area by your accountant. Okay, statement of changes in equity. I'm going to whiz through this because this is a very unsexy account, and it is for companies only. So it basically shows what happens to the profits. So if you've got profits sitting in your company, you can pay them out as dividends, or they can be kept in the business as retained earnings and used to grow the business. So you might purchase more plant or open a new location, that type of thing. For most of us, normal business owners, we just take our profits as shareholder salaries. However, when the profits start to get higher, it's beneficial to leave some in the company to get taxed at the company tax rate, because our personal tax rates are generally higher. It represents the net worth or value of the company and is a key indicator of the company's financial health. It also shows whether the company is solvent or not. Remember, that's if your liabilities are more or less than your assets. Excuse me. So here's a quick squiz at the equity statement. If you have a company, you will have seen this before. So you can see this company has accumulated loss for at least 3 years, and which means there's no retained earnings and it's currently insolvent. So there would be no dividends to pay, and no money to reinvest. And generally it means that the shareholders have been putting money into the business to keep it going. It could be a growing business. And I'm just thinking back, I think Xero was like this when it first started. It probably still is now. You would invest in the company and keep investing because they were growing and putting money into its software. And so you never got paid out dividends. Random fact. Okay, so shareholder current account. This is once again an account that business owners get very confused about. And so it is the account that records all of the transactions between the shareholders and the company. So you, as a shareholder, you're a separate person and the company is separate to you. So this account records all the transactions between the two, and any money that you put in and any money that you take out goes through this account. So it's kind of like your mini bank account with the company. It helps you monitor your personal ins and outs with the company, and maintains a balance of the amount of cash each shareholder has introduced if you've got more than one shareholder. If the account is overdrawn, which means you as a shareholder have taken out more money than you've put in, and that means you now owe that money to the company. And to put the account back into a positive balance, the shareholder can repay that money, or the company can increase its profit, like we've been doing with the example, and do a shareholder salary or a dividend too, and that goes through the current account. If it's overdrawn, it's important to get advice from your accountant because that has ramifications on your tax as well. And that is a quick example of a current account there. Once again, if you have a company, this will look familiar to you. It shows that there's an opening balance of just under 30,000 at the start of the year. He's introduced $2,000 to the business, and he has taken out $9,000, $8,000 in drawings and $1,600 in life insurance. So this means that at the end of the year, the company owes Mr. Doe just under $22,000. So the amount owed by the company to Mr. Doe can be repaid if the company is solvent and has the cash. So you can take that, and you personally don't have to pay tax on that because you have already paid tax on previous shareholder salaries if that's what you've been doing. However, because the company is insolvent, it's likely that Mr. Doe will need to put more money into the business and to support it while it's making losses. I'm just whizzing through here because it's getting a bit wordy. So basically, it's not sustainable for shareholders to keep introducing money into the business if it's not profitable. But once again, you would look towards your plan and your vision for the company. If part of your plan is to make a loss for the first 2 or 3 years, then you this isn't a surprise to you. You understand exactly where the business is going. However, if you've been working your butt off and you expect to get to the end of the year and have a nice big juicy profit and healthy shareholder salary, and you don't, then something's gone terribly wrong with your plan, and you do need to just jump in and have a chat to your business coach or your accountant to go through those reports with you and see what happened, what didn't go according to plan. Fixed asset register, basically it records all the assets that the business owns. It shows you the spread of, or actually it does it for you if it's in zero, the spread of the expense over the lives of the asset. It's a good place to keep track of the assets, and it's also a really good guide if you are like me and you like saving money to replace assets. You can use the asset register as a guide to how much to put aside in the savings account. And it's also helpful when you're selling the business because you can, obviously it's a list of all your assets, and even if it's the dirty old fax machine in the back cupboard, it's still on there and it's worth 50 cents. So it's all listed there. And so just a quick look at what your asset register looks like. And for some of you, you've probably seen this before. You may not have you probably just look down and go, yep, I own all those things, but just more specifically what each column means for you. So the first one is the name of the assets, and then you have the cost. And then the next column shows the opening value of the asset at the start of this financial year. And so this is the cost less the depreciation that's already gone in prior years. Then the next two columns show if you have any purchases or sales or disposals during the year. And then we have the depreciation rate. So if you've got, say, the computer there and the depreciation rate of 50%, that means that in the first year, 50% of that cost gets written off to your P&L, is what that means. And then each year it's another 50% of the balance. The DV stands for diminishing value. That just means that it's 50% of the balance every year. So it just whittles down. That's why you have random, like $1 balances and that sort of thing. The next column shows the depreciation for the period. So that's, for this one, $45,000. Followed by the closing accumulated depreciation. So this is the amount the asset has been depreciated since day dot, since it was purchased. So that depreciation column, that is the column that I would review to decide how much to save each month for purchasing new assets. Like I said, I'm a big fan of saving for assets, so I would go through my assets and look at what needs replacing in the next couple of years, and then look at the depreciation, and then I'd sort of use that as a guide to figure out how much I'm going to save each month. I know it's a little bit geeky, but it's so cool to be able to buy a new phone or something and you've already saved up the money. And finally, the closing value column shows the current value of the asset. So this is what would be carried through to the balance sheet. Now that doesn't necessarily, what did I do? That's tricky. It doesn't necessarily mean that that's what that asset is worth. So for instance, the car that you bought for $7,800, the book value is now $4,109. That could be a classic car, and that's now worth $15,000. So just remembering that what's on your asset schedule is all about tax, and it's the tax value. So if that was now worth $15,000, it doesn't mean you have to sell it for $4,000. By all means, sell it for $15,000 if you can get that. You will have to pay tax on the $3,717. However, you'll have the difference between $15,000 and the $7,800. That is a capital gain. That is basically, I want to say free money, but I'm an accountant and I don't think I should. So, but it's not taxed, put it that way. Okay, so if that picture is you at the moment, it's time to wake up. We are going to have a quick look at the difference between profit and cash. So it is very common for business owners to get frustrated that their bank account doesn't seem to reflect their profits. And so it's essential to understand the difference between profit and cash and why high profit doesn't necessarily result in cash in your bank. And a profitable business can go out of business because it's starved of cash, and a business running at a loss can survive because it has access to funds from investors or finances. So yeah, in other words, cash flow is every business's reality. And I totally agree with that statement. Like, I get super excited looking at turnover when it's going up, but it is all about vanity and ego, because in reality, if you haven't got the cash in the bank, like I said before, what's the point of having that $1 million turnover, in my opinion? Okay, so to demonstrate the difference between profit and cash, we've got some items to consider. So GST affects your cash balance, but not your profit. Loan repayments affect your cash balance, but not your profit. Interest on loans affects both your profit and your cash balance. Asset purchases only affects your cash balance. Asset sales only affects your cash balance. And depreciation only affects your profit. And also, just an extra on that, sales on account, so when you invoice, increases your profit in your P&L, but it doesn't increase your bank balance until you're paid. And likewise for bills, they decrease your profit and your P&L when you enter them into zero. However, they don't decrease the bank balance until they're paid. So as you can see, even if your business achieved a healthy profit, there may not be any cash in the bank after paying tax, after making your loan repayments and buying new assets. So just another way to look at that is the Business 101 cycle, which demonstrates the difference between profit and cash. So first, owners need to invest money in the business. So this is us when we are starting out. This money can then be used to purchase the assets needed to run the business. So that would be like if you were buying widgets to sell. And then the business may need additional funding to buy all the assets they need. So they may take a loan to finance the purchase. So that could be if you needed to buy plant and machinery to make your widgets. And then these assets are then used to generate a profit. And you can increase your profit by growing your sales or your sales margin. We talked about the GP percentage before. But overhead expenses can drain your profit and result in a loss if they're not managed. So this is like, keeping an eye on your insurance bill, your rent, your stationery orders, that sort of thing. Then the profit gets turned into cash when it's paid. And then drains on your cash includes slow collection of debtors. So we talked about debtor days, high inventory days and loan repayments, tax repayments and payments to suppliers. So early payments to suppliers drain your cash as well. And a business can achieve cash gains by collecting their debtors faster, decreasing their inventory days, negotiating longer payment terms with suppliers, and reducing tax. And then the owners get to take cash out of the business as drawings or personal loan repayments. And then the remaining cash then can be reinvested into the business to purchase more assets and generate more income. So this cycle spins. And I think what we talked about before with the inventory and, selling it 2 times a year rather than 4 times, this is the cycle going faster and faster to get through that to generate the more cash for the owners. So the aim is to go through the cycle as quickly as possible to increase your return on investment. And I think, Nat, I think we've actually got this thing in a picture that we can send out to people if they're interested. Right. So we are nearly at the end. Hold on there. So how does everything I've talked about today come together as best practice? So every business, I recommend using 3 essential tools. One is your annual business plan. For me, it's a no-brainer. I want to say you have it on your desk, but I've got a lot of paper on my desk at the moment. I think it's in my handbag. Keep that in your handbag, and don't file it away in the drawer. It is your go-to plan. It's every week, it's every month, it's following that and saying, what do I do next, and remembering what was important to you at the start of the year before you got busy and down into the nitty-gritty of doing business on the daily. An annual forecast, really important, especially if you've got major moves happening in your business, so like if you're taking on a new staff member this year, or I'm just thinking of all the things that I've planned for over the last couple of years. So taking on staff members, ditching a client that is quite a large chunk of your revenue, so doing a forecast to see what that would look like, planning for increased revenue lines. So for me, it was this year is looking at my coaching side of my business and what does that look like in my annual forecast. So plan that out. Give yourself a reality check. Is it going to work? And monitor that through the year with different changes and see how you're tracking, because you also want to know that when you come to pay that staff member or pay holiday pay or purchase that asset, that you're actually going to have the money there. And if you're not, you can have things in place like an overdraft or a short-term loan. And then ongoing reporting and accountability. And in my world, that's a no-brainer. I have seen such amazing results with our clients, just with that, especially that accountability, having someone to check in. I myself have 2 coaches that I check in with. They kick my ass when I am kind of hide away and be small. And so, yeah, it really makes a massive difference to your business. And of course, knowing your numbers is just the beginning, but baby steps. We're not aiming for perfection here. Business is to me, it's an evolving, I want to say beast. They can be a beast, but it's an evolving journey. Journey's a nice word. Okay, so your next steps. 1, get started now. Don't sit through however long it's been of me waffling on about financial statements and do nothing, because you've just wasted your time. So what I want you to do, here's the coach coming out of me, what I want you to do is write down 3 actions or projects that will add value to your business. So it could be a problem. A problem is an opportunity to create a project. And if you want to send them to me, and I will, give you some feedback, have a chat to you. But do that at least. Doing nothing as a business owner is not an option. Going back to work tomorrow and just carrying on same old, and burying your head in the sand isn't an option. So even if you have sat here and thought, oh my God, there's way too many numbers, that's okay too. Reach out and say, hey, I wouldn't mind going through that one-on-one. Can we do that? We're quite friendly here. So how can we help you? And so this is what we do and what we have available to our clients. We can do the business planning with you. We don't do it for you. There is no magic pill where you just say, here you go. You look after that. It's like when you when you do your website and you think someone's going to do it for you, and then they say, well, actually, you have to write the content. Business plan's the same thing. So we will facilitate that and work through it with you. Cash flow forecasts and quarterly reviews. Honestly, do your plan, put a cash flow forecast in place and review it. We can do monthly or quarterly coaching. The monthly coaching, accountability coaching, is amazing for giving you clarity and keeping you on the track that you chose when you started out. Management reporting is, we can actually set up, there's a train going past, we can actually set up the management reports in Xero for you as a custom template, and you can run it yourself. It's pretty simple. And then, of course, from this webinar, we're offering a complimentary meeting, which you can book with us, and we can run through anything that we've talked through. We can talk about the 3 actions that you've written down to take. So that is complimentary, means free. And it doesn't mean, I want to do a dad joke, it doesn't mean us sitting there complimenting each other. Okay, so yeah, we can do that. So we can send out a booking link, and you can book a time that works for you and us. Right, here is the exciting bit, and we're going to do questions, but what I really want to do is turn my stop sharing off. I just want to see who's left and who's awake. So if I do that, oh, very exciting. So Nat, was there any questions in the chats? Are you going to talk to me?
No, there was nothing, but I did put the Business 101 cycle handout in there.
Oh, awesome, clever.
Yeah.
Okay, I did have a fake question, but fake news. So I am here if you want to ask me anything. For those of you that know me, you know that I'm pretty approachable. So even if I know it sometimes can be a little bit daunting, put your hand up in front of people you don't know to ask questions, so you can reach out to me afterwards. I'm very surprised that Jeff is sitting there with nothing to say, but that's okay. I'm coming to see you next week.
Oh, you are coming down?
Yeah, I will message you because I'm hitting Christchurch. So
Awesome. I better wash a cup for your coffee then.
Coffee? I'm sorry.
Wine glass, you mean?
Hey?
Wine glass, you mean?
Oh, shit, sorry.
Yeah, come on, Jeff. Okay, team. Well, I'm going to leave it there. Oh my goodness, it's 3 minutes to 8. We are awesome. I hope that you, actually no, I trust that you have got some light bulb moments from this, or at least looked at things and thought, there's more I could know about this. Even if I may have went a little bit too fast over some things and you want to sort of have another look or ask a question, that's all good. Get in touch with me. I do know that a lot of that stuff is like what the actual, so it doesn't mean that you can leave it. As business owners, we have a responsibility to step up and learn that stuff. Because like I said before, the tiniest little tweak can make a massive difference to your business. So please reach out to me if you want some help. And I'm going to sign off there because 2 minutes to waffle. All right. Thanks, guys, for tuning up. It's been really awesome. Bye-bye.
Thanks, Carl.